guest, Nipun Mehta, now joins us. Nipun, good afternoon. What is the sense that you get looking at the volumes in the market? Is it because of the Brexit impact that now people are waiting and watching for some better direction to come in and then probably take big bets?
Well, good afternoon, Pankaj. Yes, I think the kind of lack of volumes that you're seeing and the kind of lack of volatility over the last 2 trading days, it's becoming gradually obvious that people are waiting and watching. You've seen significant currency and equity market volatility over the last few trading sessions in the global markets, but the Indian markets haven't really got affected. We've seen trading within a very limited range, which is also good for the markets. You're seeing consolidation at the current levels. Consolidation with higher volumes would probably have given a lot more confidence in the markets, but nevertheless, I think it's clearly a wait and watch that you are seeing, and which, like you were saying, very surprising in an expiry week when you are 2 days away from expiry. If this is the kind of limited movement that happens, that is certainly surprising. But yes, I think clearly a wait and watch policy that the markets are adopting, and because of which you're seeing limited volumes as well.
Right. How would you look at the move coming in Lupin today, or maybe a HUL idea as well? You think names which were underperforming so far are now seeing some sort of action?
I think to a degree it is those underperforming names. You're also seeing maybe event-based or announcement-based movement in certain cases. You'd seen some movement happening as far as the FMCG pack is concerned. You hadn't really seen it in virtually the entire space. There were 1 or 2 underperformers which were there, which are clearly playing catch up today. You're seeing 1 or 2 stocks also, large caps within the FMCG space touching 52-week highs. So it's a gradual catch up. I think when you look at individual sector benefits that some of these companies are expected to derive out of improved monsoon or out of an improved.
I think we have some issue.
We have a bit of a connectivity problem there, but Pankaj, you know what is likely to happen at a time like this when there's so much volatility across the globe? I know everyone is coming in and saying that India is insulated, India is the least likely to be affected. But if you are an investor, if you are a trader, you're obviously going to be a little light in the market at this moment. And if you really don't have to invest, then you'll try to avoid trading or investing at the moment, unless you're getting things very cheap. And right now, actually, you haven't got things very cheap, because what is the total correction we saw? We saw about 600 points the other day, and in the last 2-3 days, about 2 days, I get about 70-80 points have been recovered, or when it comes to the Sensex. So it's not a really deep correction where you look at it and say, wow, things could not be cheaper. Let's just go and buy it. Obviously, that's what would be weighing on an investor or a trader's mind. So whatever it is, expiry week and stuff like that, people are going to be a little light in the market, and understandably so.
Absolutely. And overall, if you get a sense, it was a much awaited event. An event to go into. We did get a surprise coming in. So, global investors would be waiting that, what essentially they should do going ahead, because they are not playing only India like our domestic investors. So they would be waiting for, what is happening with other emerging markets, what's happening with the EU region, and then probably start to take big bets. Nipun Mehta is back with us. Nipun, underperforming names are doing well. You think that precisely the reason which Anand just mentioned, that at least they were looking cheap after the recent underperformance?
Well, in certain cases, yes, there is a valuation differential that is coming in. But I think one must remember that the kind of impact that Brexit is likely to have on European markets or on the EU or on the extent of growth that could get affected, or even on the extent of spending that could happen within EU, the kind of capex that could otherwise have gone into from Indian companies or even from the companies within EU, is something that's going to sort of restrict the kind of exposure that you're likely to see within Indian markets as well. So you might not see a whole hog investing happening. I think that wait and watch is something that a lot of investors would want to see, given the kind of subsequent collateral damage that could be there within the EU, given coming out of the Brexit development. So yes, I think it's a to a degree it's a wait and watch. People certainly are sitting on cash. That left out feeling was there maybe a few weeks back when you saw a rally happening, a unidirectional rally happening. With this kind of a correction, the investors do feel that opportunity does exist, but nobody is obviously in a hurry to take exposure, given the kind of global volatility that continues to be there. You've seen, in fact, European markets falling virtually 2 or 3% on a given day and rising on subsequent days. So obviously it's uncertain times. Currency is something that is going to play an important role. Not just in the form of the impact on trade in terms of imports and exports, but also on the extent of FII investment that's likely to happen. There is that sort of fear or possibility that rupee could depreciate further from current levels, and that's when you could probably see increased FII activity levels coming in. But clearly, it's a to a degree wait and watch. Even though, or despite the fact that India is constantly being tipped as a serious investment opportunity going forward with the kind of reforms that are happening. But our sense is that this.
Nipun, if I had to look at any of the sectors right now which are insulated to a certain extent, which are entirely dependent on the domestic play. Sugar, for instance, I know there is a bar on exporting, and if you look at the prices that you get by exporting, this currently lower than the domestic prices that are fetching. Sugar, would you be taking positions in sugar even after this run up in the last few days?
I think the valuations to a degree are becoming stretched as far as sugar is concerned. It has always been a sector with a lot of government pricing intervention, which has ensured that large institutional players don't typically get into this sector. You've also seen or continue to see significant losses on the books of most of these sugar companies, brought forward losses, which means that there's been a very high level of debt that is there. So it's an opportunistic investment that is there as far as the sugar space is concerned. It's difficult to predict how long this kind of a bull cycle within the sugar space will continue. You've seen a huge amount of pricing volatility that has happened, both central and state government intervention that continues to happen. So yes, it's been a sort of market outperformer for some time now, but our sense is the valuations are getting stretched and one needs to be cautious in that space.
All right, let's look at something like public sector banks. They've been beaten down badly. There's still not enough clarity whether we are through with the declaration of bad loans and the kind of bad debt that's on their books. But is there any space where you think that it is time to start picking up public sector banks gradually?
Well, I think public sector banks, with the kind of underperformance that was there, I think after the March quarter results, you've seen close to about 20-25% up move in most of them. I think depending on the kind of commentary that a lot of these banks have given on whether they are through with their provisioning or not, you're likely to see movement. So as an example, maybe something like a Bank of Baroda or a PNB have risen significantly last, let's say, month or so after the results were declared.